The Great Depression did not arrive as a sudden accident. It emerged slowly, quietly, out of a world that believed it had finally mastered economic instability. To understand how such a catastrophic collapse could occur, we have to begin in the decades before the crash, in a global system already carrying deep structural stress. In the late 19th and early 20th centuries, industrial economies were transforming faster than their institutions could adapt. Railroads stitched continents together. Factories multiplied output beyond anything previous generations had imagined. Finance became more abstract, more distant from physical goods, more dependent on confidence rather than cash. These changes brought unprecedented growth, but they also introduced fragility. The First World War shattered what remained of the old economic order. Europe emerged deeply indebted, physically damaged, and financially dependent on the United States. Nations that had once been creditors became debtors. Gold reserves were depleted or unevenly distributed. Entire labor forces were disrupted, while governments took on massive obligations to veterans and reconstruction. The war did not end instability, it merely paused it. In the aftermath, policymakers attempted to restore the pre-war system as if nothing fundamental had changed. Currencies were pegged back to gold at old exchange rates, even though productive capacity, population structures, and capital flows had radically shifted. This effort to return to normal introduced hidden stress into national economies. Wages struggled to keep pace with productivity. Prices failed to reflect underlying supply and demand. Credit began filling the gaps. The United States emerged as the dominant industrial and financial power, but its prosperity was unevenly distributed. Productivity surged, yet real wages lagged behind. Corporate profits rose faster than household income. Farmers, in particular, faced chronic overproduction and falling prices throughout the 1920s. Entire rural regions entered a quiet depression long before 1929. To maintain consumption, households increasingly relied on credit. Installment plans allowed consumers to buy automobiles, radios, and appliances without the income to fully support them. Businesses expanded capacity based on optimistic demand forecasts. Banks lent aggressively, assuming continued growth would cover rising leverage. Debt quietly replaced income as the engine of economic expansion. Financial markets reflected this optimism. Stock prices climbed not because profits were soaring, but because expectations were. Speculation became normalized. Leverage multiplied returns until it wouldn't. The market was not merely overvalued, it was structurally dependent on perpetual confidence. Meanwhile, the global system remained tightly coupled. International trade depended on stable currencies, predictable capital flows, and synchronized growth. When one major economy slowed, the strain transmitted outward. There were no effective shock absorbers. Monetary policy was constrained by gold. Fiscal policy was restrained by fear of deficits. Central banks prioritized currency stability over employment or output. In short, the world that preceded the Great Depression was one of impressive surface prosperity built atop unresolved imbalances, uneven income distribution, excessive debt, rigid monetary systems, fragile international finance, and institutions unprepared for systemic failure. The collapse did not begin with panic. It began with confidence, too much of it too narrowly shared and too poorly understood. In the next segment, we'll move closer to the edge, the speculative boom of the 1920s, the mechanics of financial excess, and why the system had no graceful way to slow down once it began accelerating. By the mid-1920s, the economic machine of the industrial world, especially in the United States, appeared unstoppable. Output was rising, unemployment was low, and new technologies were reshaping daily life. To contemporaries, this looked less like a fragile boom and more like a permanent upgrade to modern prosperity. In hindsight, it was a system accelerating without brakes. At the center of this acceleration was financial speculation. Stock markets increasingly became detached from the productive economy they were meant to represent. Share prices rose not because firms were generating proportionally higher profits, but because investors believed prices would continue to rise. That belief became self-reinforcing. As long as markets climbed, the assumption of safety seemed justified. Crucially, speculation was fueled by leverage. Investors no longer needed full cash payment to buy stocks. Instead, they could purchase shares on margin, borrowing most of the purchase price from brokers or banks. A small increase in stock prices could produce enormous gains on invested capital. This magnification of returns made speculation appear rational, even prudent. But leverage cuts both ways. Small losses are also magnified. The system became exquisitely sensitive to price movements. Stability depended not on fundamentals, but on the absence of fear. Any sustained decline would trigger margin calls, force selling, and cascading losses. Banks played a central role in this process. Commercial banks, often lightly regulated, channeled deposits into speculative loans. Some directly invested in equities themselves. Others extended credit to brokers who fueled margin trading. Depositors believed their money was safe. Banks believed rising asset prices reduced risk. Both assumptions depended on continued growth. At the same time, corporate behavior reinforced financial excess. Firms increasingly issued stock rather than reinvesting profits. Executive compensation became tied to share prices. Mergers and consolidations inflated valuations without improving productivity. Accounting standards were weak, allowing earnings to be smoothed or overstated. Transparency lagged behind financial innovation. The Federal Reserve, still a young institution, faced a dilemma. It recognized speculative excess but lacked clear tools or political support to address it. Raising interest rates risked slowing industrial output and international capital flows. Lowering rates encouraged further speculation. Monetary policy was constrained by gold reserves and fragmented regional banking systems. The result was hesitation rather than decisive action. Meanwhile, inequality widened. Wealth concentrated in financial assets held by a narrow segment of society. The majority of households remained dependent on wages and credit. When asset prices rose, the benefits accrued unevenly. When debt expanded, the risks were broadly shared. The economy became top-heavy, with demand increasingly dependent on borrowing rather than income growth. Internationally, capital flowed towards speculative markets rather than productive reconstruction. European economies struggled under war debts and reparations, while U.S. financial markets absorbed global savings. This imbalance drained resilience from a global system. When stress emerged in one market, there were few alternatives to absorb the shock. Importantly, there was no widespread sense of imminent danger. Economists debated whether a new era of permanent growth had arrived. Policymakers reassured the public. Financial journalism celebrated innovation and democratized investing. Risk was rebranded as opportunity. The system did not fail because participants were irrational. It failed because rational behavior within a distorted system amplified fragility. Each actor, investors, banks, firms, policymakers, responded to incentives that made sense locally while undermining stability globally. By the late 1920s, the economy was no longer balanced. It was suspended, held aloft by confidence leverage, and the assumption that markets could correct themselves gently. In the next segment, that assumption begins to unravel. We'll examine the crash itself, not as a single event, but as a process, and why what followed was far worse than anyone expected. When the stock market finally turned in 1929, it did not collapse all at once. It fractured. Prices wavered, recovered, and then fell again, creating confusion rather than clarity. Early declines were interpreted as healthy corrections. Many investors believed the system was purging excess and would soon resume its upward path. This belief delayed meaningful responses and made the eventual damage far worse. As prices slipped, leveraged investors faced margin calls. Brokers demanded additional cash or forced liquidation of stocks. Selling accelerated not because investors lost faith in the economy, but because they lacked liquidity. Falling prices triggered more selling, which pushed prices down further. What had once amplified gains now amplified fear. The crash reached public consciousness in late October 1929. Trading volumes surged. Prices fell faster than information could travel. Panic spread unevenly. Some investors sold everything, others held, convinced recovery was imminent. There was no unified response, only fragmentation. Markets briefly stabilized, reinforcing the belief that the worst had passed. But the real damage was not confined to equity prices. The crash destroyed balance sheets. Paper wealth evaporated, but debts remained. Households cut consumption. Businesses delayed investment. Banks, suddenly uncertain about the value of their assets, tightened credit. What had been a financial shock began spreading into the real economy. Banking fragility turned a market correction into systemic failure. Banks had low capital cushion and few safeguards against mass withdrawals. When depositors grew anxious, they rushed to withdraw funds. Even solvent banks could fail under sudden demand for cash. Bank failures multiplied, destroying savings and eliminating credit precisely when it was most needed. As credit contracted, production slowed. Factories reduced output. Layoffs followed. Unemployment rose rapidly, which further reduced consumption. This feedback loop, falling income leading to falling demand, leading to further income loss, became self-reinforcing. Policy responses were hesitant and, in many cases, counterproductive. Central banks prioritized protecting gold reserves rather than stabilizing employment or output. Interest rates remained high relative to collapsing demand. Governments cut spending to balance budgets, withdrawing support from an already shrinking economy. The prevailing belief was that markets would self-correct if allowed to clear. Internationally, the collapse transmitted quickly. Countries dependent on exports to the United States saw demand evaporate. Capital flows reversed. Currency pressures intensified. Nations responded by raising interest rates, cutting imports, and imposing trade barriers, measures that protected individual balance sheets while worsening global contraction. Perhaps most damaging was the erosion of trust. Trust in banks. Trust in markets. Trust in institutions themselves. Economic relationships rely on confidence that contracts will be honored, deposits will be safe, and tomorrow will resemble today. Once that trust broke, economic activity slowed, not just because of material constraints, but because of fear. What made the Depression so severe was not the crash itself, but the absence of stabilizers. There was no deposit insurance, no automatic fiscal support, no coordinated monetary response. The system had no mechanism to stop the downward spiral once it began. By the early 1930s, the crash had evolved into a full-scale economic depression, deep, persistent, and global. What had begun as a financial correction had become a breakdown of economic coordination itself. In the next segment, we'll examine why the downturn lasted so long, how policy choices intensified the collapse, and why recovery proved far more difficult than anyone anticipated. By the early 1930s, the world was no longer dealing with a temporary downturn. It was facing a systemic contraction with no clear bottom. Yet the policies adopted in response to the crisis often intensified the damage rather than containing it. What followed was not just economic collapse, but a failure of economic understanding. One of the most destructive forces during the Great Depression was deflation. As demand collapsed, prices fell across nearly all sectors. At first glance, falling prices might seem beneficial to consumers. In reality, deflation increased the real burden of debt. Loans taken out under higher price levels became harder to repay as incomes declined. This transferred wealth from debtors to creditors and accelerated bankruptcies. Deflation also altered behavior. When prices are expected to fall further, consumers delay purchases and businesses postpone investment. Why buy today if goods will be cheaper tomorrow? This hesitation reduced demand even more, reinforcing the downward spiral. The economy became trapped in a feedback loop of falling prices and falling activity. Monetary policy worsened the situation. Central banks, constrained by the gold standard, prioritized maintaining fixed exchange rates over supporting domestic economies. To defend gold reserves, interest rates were raised or kept high despite collapsing output. Credit became scarce precisely when expansion was needed. Liquidity shortages turned into solvency crises. Bank failures accelerated. Without deposit insurance, rumors alone could trigger bank runs. Each failure destroyed not only savings, but confidence in the entire financial system. Surviving banks responded by hoarding cash and cutting lending. Money supply contracted sharply, intensifying deflation. The financial system began to actively drain economic activity instead of supporting it. Fiscal policy offered little relief. Governments, fearing deficits and currency instability, cut spending and raised taxes. Balanced budgets were treated as moral imperatives. Public works were limited, social safety nets were minimal, and unemployment relief was often local and inadequate. Instead of counteracting the collapse, fiscal policy moved in the same direction as the downturn. International policy choices compounded the crisis. Trade barriers rose sharply as countries attempted to protect domestic industries. Tariffs reduced global trade volumes, further depressing production. Currency devaluations triggered retaliation rather than cooperation. The global economy fragmented into competing national systems, each weaker than before. Underlying these choices was a belief that economic pain was necessary, an unavoidable cleansing process that would restore balance. Policymakers feared that intervention would distort markets, reward imprudence, or undermine long-term stability. The result was paralysis at precisely the moment when coordination was required. The human cost was immense. Unemployment soared into the tens of millions worldwide. Long-term joblessness eroded skills and social cohesion. Poverty deepened even in industrialized nations. Economic insecurity reshaped politics, fueling radical movements and undermining democratic institutions. What made the Great Depression distinct was not simply its severity, but its persistence. Years passed without recovery. Each failed policy response eroded confidence further. The economy did not rebound on its own. It remained trapped by its own constraints. In the next segment, we'll explore what finally began to change, the shift in economic thinking, the slow emergence of new policy tools, and the early steps that started to break the deflationary grip. By the mid-1930s, it became clear that the Great Depression would not resolve itself. The idea that markets would naturally self-correct had collided with years of persistent unemployment, deflation, and social strain. Slowly, unevenly, a new understanding began to take shape. The problem was not merely economic imbalance, but insufficient demand, and the system needed active intervention to restore it. One of the first meaningful shifts came through monetary realignment. Countries that abandoned the gold standard earlier generally recovered sooner. Breaking the rigid link between currency and gold allowed central banks to expand the money supply, lower interest rates, and ease credit conditions. This flexibility did not immediately produce growth, but stopped the deflationary bleeding. In the United States, policy began to shift decisively in 1933. Bank holidays stabilized the financial system by halting panic withdrawals. New regulations separated commercial and investment banking, reducing speculative risk. Deposit insurance restored public trust, encouraging savings to return to banks rather than remain hoarded. These measures did not eliminate fear, but they contained it. Fiscal policy also began to evolve. Governments started to accept that deficits were not merely tolerable during downturns, but necessary. Public works programs injected income directly into households, creating jobs and restoring purchasing power. Infrastructure investments produced lasting assets while stabilizing demand. Social safety nets reduced the severity of income shocks, preventing complete collapse in consumption. This shift in practice was mirrored by a shift in economic thought. The idea that unemployment could persist indefinitely due to insufficient demand gained traction. Markets were no longer assumed to automatically produce full employment. Instead, governments were seen as having a role in stabilizing the business cycle, counteracting downturns rather than waiting them out. However, recovery was slow and incomplete. Investment remained cautious. Global trade had not fully recovered. Financial scars lingered. Political instability continued in many regions. The economy improved, but remained vulnerable to renewed contraction. Indeed, premature policy reversals demonstrated how fragile the recovery was. Efforts to reduce deficits and tighten monetary policy in the late 1930s triggered renewed downturns. These setbacks reinforced the lesson that recovery required sustained support, not temporary relief. Full recovery ultimately came not through gradual policy refinement alone, but through massive external demand generated by global rearmament and war. The scale of industrial mobilization overwhelmed the constraints that had limited peacetime recovery. While war is not a solution, it revealed the latent productive capacity that had remained idle for years. The legacy of this period reshaped economic institutions for decades. Central banks gained broader mandates. Governments accepted responsibility for macroeconomic stability. Financial regulation became a cornerstone of policy. Social insurance was no longer viewed as optional, but essential. In the next segment, we'll step back to examine the Great Depression's lasting structural lessons, what it permanently changed about capitalism, governance, and economic risk, and why those lessons still matter today. The Great Depression did more than devastate economies. It permanently altered how modern societies understood risk, responsibility, and the role of the state. The trauma of prolonged mass unemployment and institutional failure left a deep imprint on economic design, reshaping capitalism rather than replacing it. One of the most enduring changes was the acceptance of macroeconomic management as a core function of government. Before the Depression, economic downturns were largely seen as natural cycles to be endured. Afterward, stabilization became an explicit policy goal. Governments assumed responsibility not just for budgets, but for employment, growth, and financial stability. Financial systems were redesigned with resilience in mind. Banking regulation tightened. Capital requirements increased. Speculative activities were constrained or separated from core financial functions. Deposit insurance institutionalized trust, transforming banking from a confidence-based system into one backed by public guarantees. Crises would still occur, but they would be slower, more containable. Central banking evolved as well. Rather than focusing narrowly on currency stability, central banks gradually adopted broader mandates, including employment and output. Monetary policy became an active tool rather than a passive guardian of gold reserves. The ability to expand or contract liquidity in response to conditions became central to crisis management. Fiscal policy underwent a parallel shift. Deficits lost their stigma during recessions. Countercyclical spending became an accepted response to downturns. Automatic stabilizers, such as unemployment insurance and progressive taxation, were embedded into economic systems, reducing volatility without requiring new legislation during crises. Labor markets also changed. Collective bargaining gained legitimacy. Minimum wages, labor protections, and social insurance aimed to stabilize income and consumption. These measures were not merely social reforms, they were economic stabilizers designed to prevent demand collapse. International coordination improved, though imperfectly. Institutions were created to manage trade, finance, and development, reflecting the understanding that economic isolation worsens systemic risk. While national interests remained dominant, the idea that global stability required cooperation gained ground. Importantly, the Depression reshaped public psychology. Economic security became a political expectation. Persistent mass unemployment was no longer tolerated as an acceptable outcome of market forces. This expectation constrained policymakers, but also stabilized societies. Yet these reforms introduced new trade-offs. Public guarantees encouraged risk-taking. Fiscal expansion increased debt. Regulations sometimes reduced flexibility. Over time, memories of the Depression faded and confidence in markets returned. Each generation reinterpreted risk through its own experiences. The Depression did not eliminate cycles, it changed their character. Crises became less frequent but more complex, often emerging from financial innovation or global imbalances rather than simple overproduction. In the next segment, we'll compare the Great Depression to later crises, especially modern financial shocks, to see what was learned, what was forgotten, and how close contemporary systems have come to repeating the same mistakes. The Great Depression is often treated as a historical outlier, but its underlying dynamics continue to reappear in modified forms. Later financial crises did not replicate the Depression exactly, but they echoed its structure. By comparing these events, we can see which lessons were absorbed and which vulnerabilities remain unresolved. Modern crises tend to begin in financial systems rather than in production. Asset bubbles inflate on optimism, leverage, and innovation. When they burst, balance sheets contract, credit tightens, and the real economy follows. This pattern closely resembles the early stages of the Great Depression, though the transmission mechanisms have evolved. A key difference lies in policy response. In later crises, authorities moved faster and more aggressively. Liquidity was injected. Interest rates were cut. Governments ran large deficits. Banks were stabilized rather than allowed to fail en masse. These actions prevented deflationary spirals from fully taking hold. However, speed and scale came at a cost. Interventions increasingly relied on central banks expanding their balance sheets and influence. Asset prices were stabilized, but inequality often widened. Financial markets recovered faster than labor markets. This divergence echoes pre-depression imbalances, though the consequences unfolded differently. Another similarity lies in debt dynamics. Just as households and firms in the 1920s relied on leverage to sustain demand, modern economies often depend on debt expansion. When income growth lags, borrowing fills the gap. This keeps systems functioning, but increases fragility. Debt postpones adjustment rather than eliminating it. Globalization has amplified both resilience and risk. Capital moves faster. Supply chains are longer. Shocks transmit more quickly. While international coordination has improved, political constraints often limit cooperation. Fragmentation reemerges during stress, just as it did in the 1930s. One critical distinction is the presence of automatic stabilizers. Unemployment benefits, deposit insurance, and fiscal transfers prevent total collapse in consumption. These mechanisms did not exist during the Great Depression. Their presence reduces severity, but does not prevent crises entirely. Financial regulation, too, remains cyclical. Periods of stability encourage deregulation and innovation. Risk migrates to less visible corners of the system. When crises emerge, they often do so from areas policymakers were not watching, much like margin lending in 1920s. Perhaps the most persistent echo is psychological. Confidence expands faster than caution. Success breeds complacency. Each generation believes it has solved the last crisis until a new one reveals unseen weaknesses. The Great Depression was not a failure of capitalism alone. It was a failure of governance, coordination, and imagination. Later crises show improved tools, but similar blind spots. In the next segment, we'll turn explicitly toward the future. Could something like the Great Depression happen again? And if so, what would it look like in a 21st century economy? The question is not whether economies can collapse again, but how a collapse would unfold under modern conditions. A future depression would not look like breadlines and bank runs, at least not at first. It would emerge through different channels, shaped by technology, policy tools, and global integration. But the underlying mechanics would be familiar. At its core, the Great Depression was a failure of aggregate demand combined with a financial system unable to absorb losses. Those vulnerabilities have not disappeared. They have been rearranged. One major risk lies in debt saturation. Modern economies operate with historically high levels of public, corporate, and household debt. As long as interest rates remain low and incomes grow, this debt is manageable. But if growth slows while debt servicing costs rise, the system can lock up. Spending contracts not because people want to save, but because they must. This mirrors the debt deflation dynamic of the 1930s, even if prices do not fall outright. Another vulnerability is financial concentration. While banks are better regulated, risk has migrated into large institutions, shadow banking systems, and globally interconnected markets. When confidence breaks, liquidity can evaporate across borders in seconds. The speed of modern finance reduces reaction time. Stabilizers must act instantly, or not at all. Asset dependence is also more pronounced. Consumption and investment increasingly rely on asset values, housing, equities, pensions, rather than wages alone. If asset prices fall sharply and remain depressed, households reduce spending even if they remain employed. This creates a slow-moving demand collapse that does not require mass unemployment to begin. Monetary policy, once a powerful shock absorber, faces diminishing returns. Interest rates cannot fall far below zero without distortions. Central bank balance sheets are already large. Future crises may arrive with fewer tools available, forcing greater reliance on fiscal policy, politically harder to deploy at scale. Globalization introduces another layer of risk. Supply chains are efficient but brittle. Trade disruptions, geopolitical fragmentation, or synchronized slowdowns can propagate rapidly. In a world where many countries tighten simultaneously, global demand can fall faster than any single government can offset. Crucially, expectations still matter. If businesses and households believe stagnation will persist, they behave defensively. Investment freezes. Hiring slows. Even well-designed policies struggle to overcome pessimism once it becomes entrenched. This was one of the Great Depression's most destructive features, and it remains difficult to counter. That said, a modern depression is less likely to unfold unchecked. Automatic stabilizers, deposit insurance, and crisis playbooks provide real protection. Governments understand the cost of inaction far better than their predecessors did. The first response today would likely be expansionary, not restrictive. But protection is not prevention. The more the system relies on confidence, leverage, and asset prices, the more vulnerable it becomes to coordinated loss of belief. A depression today would likely appear as prolonged stagnation, suppressed growth, recurring crises, and widening inequality rather than sudden collapse. In the final segments, we'll bring these threads together, examining warning signs, pressure points, and what distinguishes a severe recession from a true depression in the modern era. Not every economic downturn is a depression. Most recessions are sharp but short, painful but contained. What distinguishes a depression is not the initial shock, it's what happens after. The danger lies in persistence, feedback loops, and the slow erosion of economic capacity. Understanding the warning signs means recognizing when an economy is no longer healing itself. One of the clearest signals is duration. Recessions become depressions when recovery repeatedly fails. Output stabilizes at a lower level. Employment improves briefly, then stalls. Each attempted rebound loses momentum. This pattern indicates structural damage rather than cyclical weakness. In the 1930s, years passed without a return to prior employment levels. The same risk exists whenever growth remains chronically below potential. Another warning sign is investment paralysis. In healthy recoveries, private investment leads the way. Firms expand capacity, adopt new technologies, and hire in anticipation of demand. In depressions, investment remains weak even when borrowing is cheap. Businesses prioritize survival over expansion. Cash accumulates without being deployed. This reflects not financial constraint, but deep uncertainty about the future. Labor market scarring is equally important. Long-term unemployment erodes skills, attachment to the workforce, and productivity. Even when jobs return, they often pay less or offer less stability. This reduces lifetime income and future demand, locking in stagnation. A depression is not just lost output, it is lost potential. Financial symptoms also evolve. In recessions, banks hesitate. In depressions, they withdraw structurally. Credit flows favor large, low-risk borrowers, while smaller firms and households are rationed out. This starves the most dynamic parts of the economy. Risk aversion becomes embedded in institutions rather than driven by temporary fear. Another signal is policy exhaustion. When governments and central banks deploy stimulus repeatedly with diminishing effect, it suggests deeper imbalance. Each intervention prevents collapse but fails to restore momentum. This creates a fragile equilibrium, stable but stagnant. Over time, political resistance to continued intervention grows, even as withdrawal risks renewed contraction. Social indicators matter as much as economic ones. Rising inequality, declining trust in institutions, and political polarization often accompany prolonged economic stress. These are not side effects, they actively reduce policy effectiveness. When consensus breaks down, coordinated responses become harder to sustain. Internationally, warning signs include synchronized slowdowns. If multiple major economies stagnate simultaneously, export-led recovery becomes impossible. Protectionism, capital controls, and strategic decoupling further weaken global demand. This mirrors the fragmentation of the 1930s, albeit in a more complex form. What makes depressions especially dangerous is their subtlety. They do not always announce themselves with crashes. They creep in through underinvestment, pessimism, and normalization of low expectations. Societies adapt downward, mistaking endurance for recovery. The Great Depression taught that the most damaging phase is not the collapse, but the acceptance of stagnation as inevitable. In the final segment, we'll draw the full arc together, what the Great Depression ultimately teaches about economic systems, risk, and resilience, and what choices determine whether future crises heal or harden into something far worse. The Great Depression remains the most consequential economic failure of the modern era, not because it was inevitable, but because it was allowed to persist. Its deepest lesson is not that capitalism is unstable, nor that markets are inherently self-destructive, but that complex economic systems require active stewardship when confidence breaks. At its core, the Depression revealed that economies can become trapped. Once demand collapses, debt burdens rise, and expectations turn pessimistic, normal corrective forces weaken. Prices can fall without stimulating consumption. Low interest rates can fail to generate investment. Labor can remain idle despite unmet social needs. These conditions are not self-correcting, they are self-reinforcing. The second lesson is that policy delay is itself a policy choice. In the early 1930s, inaction and austerity were justified as prudence. In reality, they magnified damage. Recovery did not begin until governments accepted responsibility for stabilizing demand, protecting financial systems, and sustaining employment, even at the cost of deficits and institutional change. Third, the Depression teaches that financial systems shape real outcomes. Credit availability, banking stability, and asset pricing are not side issues. They determine whether households spend, businesses invest, and economies grow. When finance fails, production follows. This remains true today, regardless of technological advancement. Another enduring lesson is the importance of social resilience. Safety nets are not merely compassionate, they are stabilizing. They preserve human capital, sustain consumption, and maintain trust in institutions. Societies that protect people during downturns recover faster and fracture less. Perhaps most importantly, the Great Depression warns against complacency born of success. Each period of stability encourages the belief that crises belong to the past. Risk migrates into new forms. Leverage rebuilds quietly. Institutions weaken under pressure to modernize or innovate. The past does not repeat, but it rhymes. Could something similar happen again in next 20 years? A collapse of equal depth is unlikely, but a prolonged stagnation, driven by debt, inequality, demographic strain, or policy paralysis, is entirely plausible. The danger is not sudden ruin, but slow erosion, an economy that functions but never fully recovers. The Great Depression did not end because time passed. It ended because policy, institutions, and expectations changed, painfully, imperfectly, and late. That remains the choice facing every modern economy, whether to treat crises as temporary disruptions or as moments that demand structural adaptation. In the end, the lesson is sobering but hopeful. Economic systems are fragile, but they are also malleable. And how societies respond in moments of stress determines whether downturns become footnotes or defining chapters in history.